Thank you for joining us today. I'm your host, Tracy Bennett. In studio with me are certified financial planners Tyler Cook and Tony Payne. And today we're talking about life insurance laddering. Life changes, and this is something that doesn't ever occur to me as an every person, but your insurance has to change with it. I think a lot of people create their insurance policies and they just kind of stick and roll with it, and then life throws you a curveball and you're not ready for it. So this is a discussion for you today. Laddering life insurance. I'm very curious by this subject. I've heard you guys talk about it before at the office. Let's tell people what it is, and then we'll get into some of the intricacies.
Yeah, the concept essentially means matching your life insurance needs with where you are in your stage of life. Our philosophy for most would be, as you grow your net worth, you're paying down debt, you're saving, you're doing all the right things. In theory, the need for life insurance should go down. And the reason why, the purpose of life insurance in our mind, the primary purpose, is to fund an unfunded goal. So think retirement, college savings, things like that. If you predecease reaching those goals, the life insurance bucket is there to make the family whole, to pay for the kids' education, and so forth. So the term layer strategy involves using different policies to match the need as you go through life. And one of the benefits for most is you can see some premium savings. So how much you're paying for these coverages versus buying one policy up front, you can actually save some money over time by using this laddering or layering strategy.
Saving money and life insurance to me is an oxymoron because I feel like it's just always so expensive.
So one of the things to break down there then, the beginning of it, I guess, how do they cost or price it out? Mm-hmm. So it depends upon your age, your health, of course, but also how long are they providing the coverage? So if they're providing the coverage for a shorter window, 5 years, let's say it was a 5-year policy, and I'm using some extreme examples here, but then that premium is going to be less because they only have to worry about the next 5 years. But if it's...
Sorry to interrupt you. They being the insurance company, paying out the money, right?
Good point. Yeah, exactly. We're talking from their perspective.
Yeah.
So the idea being if they give you a 10-year term, now they've stretched that out. Now more could happen, obviously, over the 10 years, and you'll be a little older in year 10 than what you would be in year 5. So that insurance is typically more expensive. So when we think about term layering, the concept we're going to go through, the idea is depending upon when I need it or when I might likely need it, I might be able to buy the same insurance at a lesser cost.
I think if you don't mind, let's jump back just a little bit. Does everybody at any age need a ladder policy, or is it just strictly contingent on what you were just talking about, Tyler?
Yeah, it's very specific to a certain scenario.
So you don't have to be a certain age to really consider this strategy.
No, just life insurance in general, though, as with anything, you're going to age out of being able to get a policy.
Right.
Underwriting is going to say, nope, you're too old, you're too big of a risk, we're not going to cover you.
Or it's way too expensive.
I think what Tyler's saying, too, though, is there are specific situations. It's not for everybody. It really is for when you have a specific need.
Compliance mind is good.
No.
It's true.
But yeah, it's very specific.
Yeah.
I mean, again, the idea of will you need this later in life? Maybe not. But the idea of especially earlier on where maybe you have a mortgage out there, you have kids, you have a college you might want to fund, you have a spouse that might be staying home taking care of the kids. These are all different things that might have a different timeline with them rather than, this is when I'm going to die or this is when I'm going to retire.
I think where you're going at, too, maybe was does everybody need life insurance? And that's where being fee-only financial planners, we don't sell products. We don't take commissions. So if we're going through this with a client, walking them through the process, it's truly because their plan is calling for that. Mm-hmm. And that's where we would work with a third party to actually do the insurance and actually buying the coverage. But it's not us. We're not insurance agents. We're not selling products.
Yeah, you just read my mind. My next thing I was going to say is we don't sell products, but let's, if we can, just kind of give the top 5 list of products that typically people would consider, the average person might consider. The type of life insurance policies.
Sure. I'm going to say term is usually one of the big ones. The idea being for this term, let's say 10 years. Mm-hmm. For the next 10 years, if something happens to me within that term, my family will get this payout or my beneficiary will get the payout. If something happens in year 11, there may not be automatic that I get paid out because year 11, the premium may change. And that's where we talk about these different terms and the cost behind them, because you might have a 10-year term policy that's had a flat, regular premium. You're used to that. Right. And then in year 11, it skyrockets. It's up tenfold. Well, that's where you want to make sure I'm going to plan to cancel that. I'm not going to plan to pay that year 11 giant premium But if something came up and I need it, well, maybe I have to make that decision because, there's something terminal, there's something came up that I need. I know it's going to make sense for me to pay that.
Is that typically the trigger to incorporate a ladder, the next rung of the ladder?
Timeline, exactly.
Okay.
Because let's say, you're in that world where your mortgage might be paid off in 5 or 10 years. That may be a temporary thing that you're paying for out of your income now, but the need for kids' college or the need for retirement, that may still be being funded for the next 20 years.
Mm-hmm.
So you might need that insurance only until the mortgage is paid, but I need a separate policy or I need some coverage for those other needs that were out there.
Gotcha. And should you go to the same carrier for all of those policies, or is it a better scenario to have different representation?
The classic, it depends, but if you use a broker, they can shop it out there and compare different companies to each other. And a lot of times it is a mix of different companies, and sometimes it's the same company for all three if you use 3 different policies.
And when you say broker, as the every person, it sends shivers up my back because for years I thought brokerage meant it added a fee. It adds money out of my pocket.
That's more in the stock commission world, like a broker who's selling stocks, taking commissions. That's what you're thinking of.
So you're saying that the consumer doesn't pay the broker who's selling the products.
Correct.
They're being paid by the insurance companies.
Correct.
Okay.
Yep.
I think that's helpful. Is there ever? I've heard of a permanent policy.
Yeah.
Is there? And when is that applicable? What is it? And what does it mean?
Yeah, there's a lot of variations. There's whole life. Typically, you'll hear permanent or cash value is a term you'll hear thrown out there with life insurance. There's universal life. There's whole life. There's variable universal life. You can go on and on. A lot of those are what happens back kind of in the 70s and 80s. It really got popular, but they combined an investment component with the life insurance.
Okay.
And it really confused a lot of people back when it first happened.
Yeah.
Yeah, right. And it's still very confusing today to understand. We do this all the time, but we even need to look at and bring in experts to help us with some of the complexities to it. So the idea there's a permanent benefit that's not going away. So it's not tied to a term like Tony was saying. It's not going to expire in year 11. As long as you pay the premium, the policy sticks with you. Mm-hmm. And that could be maybe for some legacy goals or some very specific tax planning, like if somebody had an estate that was above the federal exemptions. Right now it's about $26 million, so you got to be pretty wealthy. You might need a life insurance policy just to pay the tax bill to the government, as crazy as that sounds. Mm-hmm. But that would be a reason for permanent insurance.
Okay.
So there's a lot of flavors to it. There are a lot of concepts going around right now. One's called infinite banking and a few other things where they pitch these to the wealthy as a tax-free way to get money. What they don't tell you is there's loans involved, there's interest charges, there's a lot of high commissions. A lot of that stuff's buried in the fine print. So I think the permanent insurance world is where people are often sold a policy versus them proactively purchasing it themselves. Mm-hmm. And it's because it all sounds great. They hear words like guaranteed and tax-free and all those types of things, which play on the emotions. Mm-hmm. But again, is it really the right policy for you? Maybe it is, but a lot of times we see it's not.
You don't know the right questions to ask. That's the
Most
problem.
people don't, yeah.
Yeah.
And that's where we're coming from, too, with the layering approach. I mean, again, we'll say it out loud. It's a term layer approach. You may have other policies, like you mentioned, Tyler, where the premium changes and it may be permanent. And I kind of smile when I say that. It's permanent so long as you can pay the premium. So if that premium goes up double, quadruple, if it just keeps going up over time, well, that cash value or maybe money you put in there that was coming out or growing, that might slowly become diminished because that insurance cost, the actual cost of insurance, not what you mail in each year as a premium payment, but if that cost continues growing, what you think of as permanent insurance, it's only permanent if you're making that premium payment or making that cost of insurance payment.
And even sometimes the policy will have enough cash value where it can actually pay the premium or a portion of it, or there may be dividends paid. But if you're not paying attention and looking at what are called illustrations and seeing how long that lasts, you could get a nasty gram in the mail saying, hey, if you want to keep this coverage, pay us $50,000. We've seen those. I'm using an extreme example, but the idea is you got to be aware of the timeline. And if you're not writing checks and paying the premium and you're just going to let the policy pay for itself, that can only last so long.
And that's why these layered approaches, I think, are so neat, because if you're sold on the idea that I have permanent insurance, you're not really thinking of a timeline. Mm-hmm. You're thinking of, well, I have it. I have it. And what you're saying, Tyler, and I'm really leaning on you here, because when you think of this strategy, it's a way to have the insurance, but be savvy about it. Have the flexibility, have some cash now, but it's one piece of your plan. Mm-hmm. Again, it's not the investment piece. It's not the emergency reserve piece. It's not the college savings piece. But people will sometimes sell you on a product that will act like it can do all of those things. But if you're looking at your pure need of insurance, that's where this term layer approach really comes in.
I think you've got some visuals.
Yeah, let's look at an example. Yeah, I'd love to do that. So as you can see here, we'll use Ryan. So he's age 35. Based upon his conversation with an advisor, he needs $4 million of coverage. The term they selected was 30 years. Now, that could be for various reasons. That could be for getting the youngest kid through college and maybe some grad school. It could be when they're going to pay their mortgage off. It could be when they're going to retire. There's a lot of variables that go into that. But having that conversation is the key. So you see the premium there at $3,300, so $3,302. That's what a 30-year, $4 million policy would cost if you just bought one policy to cover that $4 million per year. That's right. Yep. And the preferred rates, that just speaks to health rating. As Tony said, the basics of life insurance is you have to figure out the underwriting process, right? So you go through a blood and urine test, medical underwriting, they look at your background, and then they come up with the premium. Preferred is kind of a good rate. They also have what's called standard rates, where maybe you're what they call rated for certain things that they don't like. And again, they can discriminate in the insurance world, and that's a real thing. But you get through the process. That's one option.
I didn't know that.
Yeah, you can buy one policy, cover the whole need. You pay it for 30 years. Now, to Tony's point, you're 31. That $3,000 might be $30,000, right? It would have a significant jump once that level term expires. So again, Ryan needs coverage. You can see this is to get him to age 65. So he's 35, 30-year policy, gets you to the normal retirement age, we'll call it. Again, what we said earlier, most coverages will change over time. So the layering approach, the idea is to match the coverage as where you are in your life. So again, our philosophy would be, hopefully for a lot of people, you get to year 30, one of the best conversations we have is we say, cancel the coverage. You don't need it. That's fun. That there's a lot of assumptions there, right? You've met your goals, you paid down debt, and so forth. So think about this. As you're 35 years old in our example, hopefully your income goes up over time. If you do the right things and you save that income, you're going to do things like pay down debt, your mortgage. That's the goal, at least. And so the adjusting of the coverage naturally comes with your lifestyle. So our theory, again, this should go down over time. So it gets a little complex here, but stick with me on this one. The layer approach involves 3 policies versus that first one we looked at, which was one policy, 30 years, $4 million. This layers it out and takes that $4 million death benefit and puts it into 3 different buckets. So the first policy you would look at was that 10-year level term. That's for $1 million. The next $1 million is for 20 years. And the last piece to it, the last layer, is a $2 million policy that lasts for 30 years. And as you can see there, immediately, the savings is what you see. Those 3 policies cost $2,400 per year versus that one policy we started with at $3,300. So right there, it's an $860 savings or so, right off the start. There's actually more savings that comes in later. So this next piece will really show you the breakdown. You can see the premiums there, right? It's broken down by policy. Obviously, to Tony's point earlier, the longer the term, the more expensive. So you see the most expensive policy is that 30-year level term at $2 million, $1,700 roughly per year. What I think really brings it together, I'm a visual person, I think this next graph really demonstrates this. So look at the x-axis, the horizontal there. That's the client's age. So in our example, Ryan's 35 today. Look at the y-axis. That's the amount of coverage needed. And as you can see by the blue line there, it goes down over time to what we talked about by your goals. So age 35, $4 million of coverage needed. Your total premium costs for that first 10 years. So look at the bottom, age 35 to 45. The first 10 years, you're going to pay $2,400 per year for that full $4 million of coverage. Now, age 45, you're making money, you've saved, you've paid down your debt, your portfolio is growing. We can now say, actually, you don't need $4 million of coverage anymore. At age 45, you only need 3. So now we're left with those remaining 2 policies. So that first policy goes away. You have 2 policies left. So from age 45 to 55, this is where the savings comes in. Now you're paying $2,100 per year for 10 years instead of $2,400 at the start. Again, fast forward in life, you get into your 50s, your highest earning years most likely for a lot of folks. 55 to 65, we can say, you know what? You only need $2 million of coverage now. We don't need $3 million. So you drop down another layer. So now you only have 1 policy left out of the 3 you started with, and it goes for those last 10 years. So age 55 to 65, and again, another savings comes in, $1,700 a year for the last 10 years. So the idea is again, as your plan goes on, as things get a little less convoluted, you've hopefully fewer debts. Again, portfolio is growing, net worth is growing. This allows the coverage, your life insurance coverage, to go with it. And then hopefully at age 65, we're telling you, you know what? You don't even need $2 million of coverage anymore. You're good. Just cancel it. Let it go.
So first of all, my brain is saying $1,600 for that amount of coverage in your 50s and 60s is pretty impressive.
Definitely.
Where do I get that?
Yeah.
No, and that's part of where I might come from, be the other side to this coin. This is usually a way to get someone who's already cost sensitive to buy the insurance that they need.
Yeah.
If I could
Assuming
tell
they
you,
have a retirement portfolio to get them past 65.
Yes, assuming that, but assuming that they see the value in insurance and why they're buying it. Because you may say this approach works and I can save cash, but then you're in your shoes and you're thinking, that's a wonderful deal. I wish I had $2 million that dropped off because I felt like I didn't need it. But in my 50s, I bought the lake house. I paid for the kids this. My lifestyle doubled. You know what? Like Tyler said, now I'm finally making more money. The percentage of my income that $2,400 was before, it's never been a smaller percentage of my income.
It's a great point.
So unless I'm really motivated that I need to be pinching my pennies or just, hey, you know what? I know it's obvious that this layer is going to be relevant for me. I think the purest approach may be, hate to say overpay, overbuy, but have insurance you could grow into because you know what? Maybe that $4 million isn't for me today, but if I'm going to have that family or that lake house and maybe I wake up some morning with sleep apnea and now I can't even qualify for life insurance when I'm in that period where one or two policies dropped off, that's where you have to be considerate of, am I saving now for a great reason? And if so, this is a great approach. And otherwise, if this is just, I'm going to save the most amount of money, I think that point you made of, well, geez, I wish I had an extra $2 million in my 50s or 60s comes up.
And I can't emphasize enough, too, that $4 million starting point we looked at, there's a lot of variables that go into calculating that. And it's not just enough to do it one time and then say, okay, I'm good till 65. We review it annually, at that minimum, annually, because life changes, to your point. Health issues come up, kids do things, just things change. So you've got your insurance needs should be adjusted accordingly. But sometimes it does make sense. You know what? Now I'm making more money. I'm 55 or 60, whatever the age is. And you say, I can pay that still. Maybe I don't need it, but let's just keep it for some peace of mind. That's also a conversation, too, versus just saying, let's get rid of it.
So you're basically talking about at 35, taking this policy, and then when you turn 45, dropping that policy, taking the different policy, and then so forth. That's how it works.
It's layered like that,
Yeah,
yes. You have them all set to start. All three are in
Put a
force
notification
at the same
in
time.
my phone when I turn 45.
Yeah. Well, again, just to clarify, you have all three policies from day one. It's just they start falling off as you go. Yep.
Yeah.
Okay.
So you're buying three, and instead of writing the 3 bills, year 10, year 11, really, I'm writing 2 bills, and then stretch it out. And then year 20, I'm writing the one again, I think,
right.
according to your
Right.
strategy, which, again, if you're mindful of your money and you know your needs and you've been saving towards retirement, you've been real with yourself on what your goals are and what your needs are, this is, again, a great way to save money, especially if you have a bigger need and look at these figures, add another 0 on, that's where it really may make sense to say, yes, I have a health issue. I know I need the coverage. What's the most affordable way I could do this to try to provide?
It's a great point, too. If you only needed $1 million of coverage and you're 35, most likely you just get one policy. It's when you need these multi-millions of coverage that the layering really makes sense.
Okay. The first thing that comes to my mind is insurance poor. I've heard that term my whole life. I came from a family with that insurance was not a conversation that we had. So no background or understanding of these kind of products. It took a long time to get there. And very trepidatious about knowing which product to get, where to get it.
Yeah.
So how do you avoid that?
Well, doing research. I mean, partially, if you're listening to this, you're already a step ahead because you're getting a little more awareness of what are questions to ask. Because one of the things we hit on a little bit earlier, the difference in an agent and a broker typically works for you. They work for the client. An agent works for the company that hired them. So if you think about it that way, I'd rather usually have a broker working for me than an agent working for that company. And the broker can typically represent multiple companies because they're not paid by just that one big entity. They're paid by you. So that way, or at least the product you choose. So that's where I think it's important to say, how are they getting compensated? What am I looking at in general, first of all? Then you can go in to start saying, what are my needs? And that's I hate to say fun part, but you know what? That's the algebra of it. Well, if we have a 2-income earning household, or one of us is retired, one of us has a pension, those are all going to lead to different solutions of what income needs to be insured, or what money are we going to lose if somebody went down.
Mm-hmm. The next thing I want to talk about is life insurance and how it can help divide assets or leave a legacy. So when you're talking about this strategy, how can people approach that using ladder technique?
Well, if you know you're going to have something growing in value, for instance, this can be something where, I'm going to have insurance at the very beginning while it's still growing and building. Later on, that asset itself will be enough. I don't need the life insurance at that point. Let's say it's something like a business, or you're a developer and in 10, 12 years, this will be something. But while that span is there and I'm developing or I'm building this business, we need to have this coverage. I think that's one example.
Yeah, I just popped in my head kind of a tangent to that, but talking about earlier about how do you shop these things and make sure you do the right part. I've literally heard people say, when they're trying to sell life insurance, they've said things along the lines of, I hope this is the worst investment you ever make, because in order for it to pay out, you have to die. Like, those are the sales tactics you hear. And so and it can be enticing to hear that. And you throw in the words like guaranteed and tax-free and those things, and you can kind of get off course of what you really need. So again, revisiting it annually, making sure you've got somebody overlooking your shoulder that's got your interests first, that fiduciary standard we talk about, that's critical in the life insurance analysis world.
And I'm not even going to take for granted what you did there, Tyler. I mean, the way you said that, we're all going to die. I mean, it's a great investment, right? You're going to die. Well, it all depends upon how much money did you put into this thing? What's the benefit? What's the timeline of getting the benefit? What happens if you have a year where I didn't have the income to pay for it? I lost the policy. All those premiums may be gone. You may not have anything there because, hey, I couldn't keep the insurance around. And that's the best investment for the insurance company, right, is the policy that they never had to pay out on.
So God, I feel like I'm such a petri dish of these conversations. I had somebody sell me a whole... I asked for a term policy in my 20s. Went and met with an insurance agent. Wanted a term policy. Didn't realize, because I didn't understand the language, until probably 10 years later, I had a universal term policy. And of course, that went bye-bye real fast. But you just don't know the questions to ask. So this is such great information to be able to give people, because this isn't the insurance industry is a universe just like ours.
And on the contrary, that same policy might have been a great choice for someone else.
Right.
So it's not about one name of a policy better than another.
But understanding the difference. I didn't know there was a difference. I thought it was term or whole life. That was it. That was my broad knowledge.
Yeah, just to say, just clearly too, we're not anti-permanent insurance by any means. It's just where it's the right fit. But there also are term policies that you could actually convert to a permanent policy if the provisions are there, and sometimes that makes sense to do. Mm-hmm. Then we've seen that play out. So it's very convoluted. It's a very in-depth topic. But the idea here with this term layer strategy is to match the life insurance need as your life goes on. And one of the benefits for a lot of people is they save a lot of money in the process.
And just one more thing, I can't help but add it too. If you're relying on work for your insurance, this may really come into play, because if work is providing that extra benefit to protect you and your family, and you're tied to that and you leave your employer, you may not be able to leave with that insurance in place, that life insurance. But if you've bought these insurances Tyler's talking about, or we're talking about here, well, then you can change employers, you could retire, move jobs, leave the workforce a little bit, but you're not reliant on that employer who's going to change that premium each and every year, depending upon your age, typically, where if you have a term layer, you know the premium, it's a guaranteed premium. That can also give you a lot of flexibility where you're not relying on, hey, I have to stick with this employer because my whole family's insurance relies on it.
Mm-hmm. Boy, I wish I'd known you 20 years ago.
Me too, Tracy. Me too.
Well, wait a minute.
We're almost there.
Wait a minute. 20 years ago, I've been here 30 years. Woo! 30 years ago, 40 years ago. That would have been nice. Yeah. It's kind of scary to think that you would be uninsurable. You mentioned that earlier. I can't even fathom that scenario. When and why does that happen typically?
It's the underwriting process. So the insurance company deems you're too big of a risk for certain health issues or whatever else you do, certain exposures, activities. skydiving, all sorts of things that they can limit the payouts. So the insurance company makes the decision that you're just not a good fit. Really what that means is they can't make any money off of it too. And they're worried about paying out before they make their money in the process.
And I'll share a story here, and I'll say adjacent to myself, but we were on vacation recently, a couple's on their honeymoon. I mean, honey, what a wonderful time. Great celebration. They're just building their life together. And one of the spouse has a health event, and we hear about it later on. The ambulance came, took care of them, all this and that. And we hear later on what it was. And my planner brain immediately goes to, well, shoot, they're not going to be able to buy life insurance on that person. So the idea again of maybe they could buy it, but it'll be an increased premium, like Tyler said, or they may not even be insurable because, hey, that thing you thought you stepped on, well, that was a tumor, that wasn't a rock, and now we've caught it, we've developed it, we're starting that great plan. But think about buying life insurance, forget it. Mm-hmm. And that's the other part of layering this and maybe having a little more early on.
What do people do when they're denied? Is there an option?
You really have to start planning alternatively. Mm-hmm. Maybe that's changing your saving strategy, your work strategy. I mean, it's where drastic measures usually are called for, but don't duck your head in the sand.
Okay. I want to learn more about poor timing and health changes and how that can lead you to become uninsurable. I mean, you can't help it other than going to the gym. Mm-hmm. Avoid falling down the stairs in my case, set you back about 10 years.
And we know even that's not infallible. I mean, the idea of life happens.
Yeah, it does.
You wake up that morning and that thing is just there. You rubbed your neck and, hey, that wasn't what you thought it was.
Right.
Yeah, that's, I think part of the benefit of planning ahead. When you have your estate plan done and you have to have that meeting with the doctor, you're not worried about the estate attorney after. You're not worried about going to go buy life insurance for your kids or your family's college because you've already been saving. You're already on track. I mean, when we think about this comprehensive planning stuff that we do, that's where these are all little tangents maybe. But when you're working the whole plan, when you have that event or that sad thing comes up, you're at least on much better footing than what you would have been. So again, it's not the perfect answer, but if we're all looking and paying attention to our plans ahead of that bad event, well, there's no better time to plan for it.
That's it for today. We hope you'll catch us on the next podcast. Thanks for joining us.
Boxland Media. Think big.